Gold, the most preferred precious metal of India, is going through a difficult time as its decadal returns plunges drastically. Data shows that gold has clocked in a return of just 3.4% in rupee terms in the decade gone by. This is when inflation for the month gone by went back to the levels of 7%. Therefore, should you look at gold anymore as an investment tool? Where will the prices head on, and how should you treat your gold investments? We have Somasundaram PR, Regional CEO, India, World Gold Council, and Amol Joshi, founder, PlanRupee Investment Services, joining us. Welcome, gentlemen, to this very special discussion that we are going to have, because Mr. Somasundaram, gold definitely is traditionally the most favorite asset or investment avenue that Indians prefer. But then talking in terms of investment demand, what is the outlook? How has the rally been last 10 years? How's the journey been? Just let's start with this question.
If you look at the decade, I guess we're talking about 2010, 2011, soon after the previous the first major financial crisis, we saw a huge jump in demand between 11, 12, and 13. In fact, 2013 is when we saw a biggest jump in investment gold, which is bars and coins. As far as India was concerned, there's not so much of ETF. And that's what led to certain controls, increase in duties, and all that stuff. Then came demonetization and the GST, which was rolled out, which improved transparency. Overall, what we saw between 2013, when there was peak demand, and 2020, when we saw a lot of transparency measures, the demand softened at periods, but it just hovered around 700 tons. And then COVID came. We saw a biggest drop that was essentially due to lockdown. It picked up last year. Last year, in fact, December quarter was one of the best quarters ever in our data series. So the trend was back. This year again, when the prices started rising, then we saw the demand softened again. As we are almost at the close of this calendar year, what we see is that the demand is still very soft. Prices have softened, no doubt, from the peak, but we are entering the season. We should see the demand pick up, but whether it would meet the levels that we saw last year has to be seen. It is unlikely that we are going to see a jump like last year, but overall, there is a latent demand for gold, which we believe from various studies is very, very strong.
How long do you think this weakness in the demand will be there? Usually we take it as a hedge against inflation. You know, that's the positioning gold has been. It has since a very long time, and the kind of returns in your portfolio, and even the way it stabilizes your portfolio if you're diversified in a very nice way. It gives you that kind of support and return. So can we no longer say that it's a hedge against inflation, looking at the current triggers which are running the international and Indian market?
Well, it is not right to say that it is not a hedge against inflation, looking at a very, very short-term period where the prices are being driven by various factors, essentially the US interest rates that are driving the short-term sentiment. So it wouldn't be right to draw a conclusion like that. Gold is still a very good hedge against inflation. And you yourself said it's a very good diversifier. Those qualities are still very strong. But what is happening in the very short term is very counterintuitive. Obviously, when you see inflation, uncertainty, you'd expect gold price to rise up, but that doesn't seem to be the case. That's essentially due to a very strong dollar. That's one of the reasons, and the interest rate rises that we have seen in the US market, which we believe that we will see this softness in price continuing, and therefore the consumer expectation will also be ahead of the softness. Consumers always expect that when prices drop, it will drop further, and therefore they will control their purchases. And similarly, when it starts rising, they will rush to buy. It's a phenomenon we have seen in the past as well. So currently the prices are around less than 50,000 if you look at the Indian thing, which is very attractive price. But when it comes to what is going to happen in the future, now there is obviously this rate increase, which at some stage in the future will stop. And if by that time truly these policies haven't controlled inflation, then the turnaround will be very, very sharp. even in any other case, long-term gold has always performed well. You got to look at gold over 5-10 years period and not point to point. Gold has actually had very, very good run 2020, 21. In fact, people took a lot of loans because the prices were high. They were holding gold. So you cannot look at point to point. But when you hold it over a period of time, what does it do to your portfolio? What does it do to your finances? It has always paid off when it mattered.
I also want to take this conversation on a different level when you talk about physical gold and investment, physical demand and investment demand. So Amol, maybe you can put some light on this, because I had an interaction with few jewelers last week, Amol, where they said that they are very upbeat for this festive season. The demand so far has come out really good. People are not being very conservative in putting or placing orders for wedding season and other occasion. But there has been a slight dip in their ticket price. Okay, so they are not maybe going for very expensive jewelry. So physical demand still looks intact, and the festive season, the jewelers are very upbeat about it. What is the current status when we talk about investments?
All right. So, Kavita, thanks for having me over. And I must say that the co-panelist has given the macro picture going right back to the 2008 Lehman Brothers crisis, and from there to demonetization to this stage. Now, thanks for bringing up the issue of asset allocation, diversification that you touched upon a few minutes back, and how gold will perform on the investments on the investment side. So I want to add something over here. So people probably expect, since gold is considered as a traditional asset class, people expect gold to deliver a steady 6 or 8 or 10 or whatever you have in your mind. Let's say a steady 8% kind of return. But gold doesn't do that. Now, let me take you back to the history. Let me take you back in time. Let's go to 2007, when India's first gold ETF was launched. It's a pretty popular ETF. That ETF from 2007 to 2012, in a period of 5 years, that ETF actually generated a 23 to 24% of CAGR. That is exceptionally high. It sometimes even beats one of the most volatile asset classes like equity, or within equity, the sectoral funds as well. But after that, like we have been discussing in this program, the gold, there is a lull in the prices. I also would like to add upon something very which is very behavioral, and that behavioral is gold. You and me in the studios are prone to discussing gold for a 3-year, 5-year, or a 10-year asset class. But correct me if I'm wrong here. Gold in India is generational kind of an asset class. So if we have to look at a 15, 20, 25, or even longer return phase, let me give you those numbers quickly. Gold CAGR for last 15, 20, and 25 years ranges between 11%, 12%, and in the very vicinity of very close by to 10% or so. So I would like to say, from personal investments perspective, gold still retains its place as a asset allocation or a diversification asset class. I think we have been discussing in this show. What matters is you should not go gung-ho, or you should not go all out on any one particular asset class. What I would advocate for gold, I would advocate probably something similar to debt or even equities. You should have the standard typical for a person with a moderate to aggressive risk appetite. We suggest asset allocation of close to 50 to 60% into equity, 30-35% into debt asset classes, and maybe 5% to 15%. It's a broad range, I understand, but as I mentioned, there are behavioral and social aspects to gold also. So 5 to 10% or 5 to 15% kind of asset allocation should go into your overall financial perspective. Let me add another point over here. The gold jewelry or the physical gold that you actually enjoy in the form of jewelry, in the form of other items, that essentially should not be counted into your overall asset allocation, financial assets. But I would say that 50, 55, 30, and 10% mix should work very well for investors over a medium to long time frame. Kavita.
Here is, should we pump in more money when it comes to gold investment? But before that, Mr. Somasundaram, I want you to draw us a picture by the end of this financial year, looking at the rate at which the rate hikes are happening, and it's going to be there for a couple of quarters now. Do you still see this lullness in the demand and softening in the prices, or you feel that there will be an aggressive tone to gold also in coming months?
Last year, Kavita, if you see the first 3 quarters, because we had the second wave, particularly the second quarter was a washout. The fourth quarter came back with a very significant 343 tons. Never had we had a quarter like that. It was even higher than 2013 when 80/20 was introduced. We didn't expect that because when it opened up, there was this latent demand. People rushed to buy gold. Price also softened a bit. So it is always difficult in India to forecast before you have seen the fourth quarter. Unfortunately, the fourth quarter is the calendar year and it closes the year. So it might still be very good, but looking at what is happening, looking at the trends, we think we may not be able to expect that same kind of spurt in demand. It will be another, probably a good quarter, but not very good. The monsoons have been good. So the rural agri incomes must be good. All this actually are good for gold. But prices have and are lying below 50,000. But with further rate increase and further price softening, people will generally think that there will be further price drops. So that could actually hold them back from buying their full quantity that they require. This might actually soften demand. This might soften. Actually, it's again counterintuitive. When price comes down, people buy more. But when price starts gradually coming down, people always expect that, let me wait for the, the bottom end. So you might find that there will be softness in demand. As far as the price is concerned, I've already explained. Let's not forget one thing. Between 2019, beginning of 2019, we were seeing gold price at 32,000. Today, in spite of all the softness, we are seeing it at 49,000, 50,000. That's a big jump when it comes to gold price. So that is why gold is not about a quarter on quarter, year on year price increases. It's about step changes. Now we were at 30,000. Now we are at 50,000. There will be a breakout at some stage, depending on how things pan out, and you could see another further jump. That's how the expectations are built about gold. But immediately in the short run, we will have to go by factors such as US interest rates, which has an overwhelming influence on gold. And that doesn't look very positive for gold in the short run.
Amol, now keeping all these factors in mind, which were just explained, if I want to rebalance my portfolio, do you think it's time to allocate slightly more towards gold, keeping obviously longer duration in mind, which is like maybe more than 5 years?
Yes, Kavita. So that's a great question. But let me start by saying that this would be a cardinal sin. In the sense, you never rebalance if any particular asset class is doing well or based on not doing well. You always decide your asset allocation based on your risk appetite and based on your financial goals. I give it to you that you have already mentioned a tenure, which is 5 years or more. So that's one very good data point to have. And it would make a job of a planner or advisor easy. But unless we know risk appetite of a person, because risk appetite percolates into all asset classes, it doesn't still only have to do with gold. Equity, obviously, inherently an equity, a volatile asset class. In debt, as we are in rising interest rate environment, in debt also, you and me both know that if you have longer maturity dated papers or debt funds with longer modified duration, then you are probably making mark-to-market losses or capital losses on your portfolio. So I would say this question is best decided on your risk appetite and investment horizon. However, if because of the rate softness, if your gold allocation has fallen from, let's say, 10%, which is desired allocation, to a 7% or 8%, and if there is a gap to be fulfilled, you can fulfill up to that extent. But I wouldn't advise take it from 8% to 20%, because those decisions will impact the long-term returns of your portfolio as well as the risk-adjusted return of your portfolio. Sure. So that's slightly a longer exercise. Let me cut it short by saying that you can increase it to the extent of shortfall in your asset allocation.
Got it. Got it. So maybe it's a time to buy a lot of gold jewelry. But when you talk about investment, gold growth story is not a short-term one. You should really bank in for that for a longer term. Thank you so much, gentlemen, for being a part of this show and explaining the gold trajectory to our viewers.